The Construction Market Guide is designed to provide contractors and construction executives with timely data on the economic environment, materials prices, and the labor market so you can make informed decisions that increase profitability. Let's take a look at some charts. The inflation rate has peaked and is starting to decline, which is to say that while prices are increasing, the rate of increase has slowed a bit and is starting to come down. As we look at construction input prices, there's a whole range of inputs here that, as you can see, if we look at them over a 1 month period, many of them are increasing at a small rate or declining. Some of the most notable declines are in iron and steel and natural gas prices. And as we look at the producer price index, we can see a noticeable decline here, looking back over 12 months and seeing the rate of change. So good news for inflation, in particular materials cost index when we dive into oil, iron and steel, asphalt paving mixes, and lumber. All of them are showing negative price changes over the last month. Also, some forward-looking indicators in terms of the architectural billing index. We see that in negative territory in terms of design contracts for the first time in a while. So definitely some cause for concern as we look ahead in construction. Obviously, aspects of construction that have a very long cycle to come to the construction point in the process. And large-scale projects are still doing fine, generally speaking. But as we look ahead, we're seeing some slowing and some cause for concern looking ahead. New housing starts have been falling, and a lot of that's driven by interest rates. We've seen massive increases in interest rates this year. And as we look at the bond market, we see a yield curve that shows short-term interest rates of this is Treasury rates, so what the U.S. government is required to pay in interest when we lend them money. And short-term loans have still a pretty high interest rate because the Fed has raised interest rates so much. But as we go out the curve, the longer-term time frames, loans of 10 years or more, have really fallen off. And we've seen pretty big declines, meaning that the bond market is predicting that inflation is probably not going to be as persistent as some people fear. We're going to see very likely inflation rates coming down in the future. And that's given some cause for optimism in the market, although stocks have priced in high potential for a recession. And obviously the big increases in interest rates have had a major negative impact on both stock and bond markets as well as real estate. Pretty much every sector of the economy has been down over the last 12 months. So again, a good time to review your investment portfolio, take a look at opportunities now. And for people that have a lot of cash on the sidelines, probably makes sense to keep cash in your business to prepare for a potentially slowing economy, but also some opportunities to get higher yields on safe money with short-term government bond and money market rates having come up pretty dramatically, and then also opportunities to buy stocks at lower prices given the declines that we've seen recently. If we can help you take a look at those things for you or your business, please reach out to us. We're happy to chat. Thanks.